Nobody likes to pay taxes, and well, what if I tell you legal ways to reduce or even eliminate them when it comes to your investments? Hello and welcome to our channel 5 Minute Finance by ET Money, where we talk about the basics of investing and personal finance. In this video, I am going to discuss 3 cases of investments where you can reduce your tax outgo and hence maximize the returns on your investments. The cases will be around your investments in fixed deposits, liquid funds and equities. So let's begin with our first case. Earlier, debt funds were popular and favored over fixed deposits due to lower taxes. But last year, the government changed debt fund taxation. Now, both fixed deposits and debt funds are taxed at the same rate. But there's still one key difference in taxation. With fixed deposits, you pay tax on gains every year, regardless of whether the money reaches your account or not. For instance, if you invest 1000 rupees in a fixed deposit at 8%, you pay tax on 80 rupees annually. In fact, while filing taxes, you need to report FD interest under income from other sources section. Debt funds work differently. Here, gains are taxed only when you redeem. For instance, if you invest 1000 in a debt fund, you don't pay tax until you withdraw. This feature makes debt funds a better investment option. Let's understand this with an example. So imagine you have 1.5 crore to invest for regular income, needing 1 lakh per month, which makes it 12 lakh yearly. Let's compare the tax in both cases, assuming 8% return in that you fall in 30% tax bracket. So with FDs, your 12 lakh profit is fully taxed at 30%, amounting to 3.6 lakh. In debt funds, tax is only on the profit portion that you withdraw. So from 1.62 crore, when you withdraw 12 lakh rupees, where 8% profit equals 96,000, you pay tax on 96,000 at the rate of 30%, which is just 28,800. Which is way lower than 3.6 lakh rupees. That is the taxes you would pay in case of fixed deposits for same rate of return on investments. Now, due to this tax difference, even if you earn slightly lower returns in a debt fund compared to a fixed deposit, you could still benefit. Now, coming to the next case of liquid funds versus arbitrage funds, which one is more tax efficient? So liquid funds invest in short-term assets like treasury bills, government securities, repos, CDs or commercial papers with a maximum maturity of 91 days. You can invest in them when you want to park your emergency funds or if you are looking to earn better returns than a bank fixed deposit on invested money when the withdrawal timing is uncertain. Arbitrage funds, on the other hand, part of hybrid funds, invest in arbitrage opportunities like price differences between BSE and NSE or in futures and options market. For instance, suppose Reliance shares trade at 1,257 on BSE and 1,260 on NSE. The 3 rupee difference is called arbitrage. You can buy on BSE and sell on NSE to make profits. So while you may feel that they invest in equity, so how can they be safe for short term? Well, arbitrage funds focus solely on arbitrage opportunities, which makes them safer. Coming to the returns part. So both category of funds have delivered approx 6% pre-tax returns over 3 years. But post-tax returns differ. Now, while in case of liquid funds, the profits will simply be taxed at your slab rate regardless of holding period. In case of arbitrage funds, if you sell your investments within 1 year, gains will be taxed at 20%. And long-term gains that are on investments sold after 1 year of holding period would be taxed at 12.5% on profits exceeding 1.25 lakh rupees. So if your gains are lower than that amount, you will not pay any taxes. So going by this, if you fall in 20% tax bracket or lower and are looking to invest for short-term, liquid funds may be better. But if you are in 30% tax bracket or if your investment period will be over a year, arbitrage funds offer better post-tax returns. So for emergency funds or cash not needed for a year, arbitrage funds can be a good option. Moving to the third case of saving taxes. Now, as discussed earlier, long-term capital gains offer 1.25 lakh tax exemption per financial year. You can use this to save taxes on equities. Here's how. Suppose you invest 5 lakh in an equity fund for 10 years at a 12% return. By the 10th year, your corpus grows to 15.53 lakh. If you sell your 10.53 lakh gains, qualify for LTCG tax. Now after the 1.25 lakh exemption, the taxable amount is 9.28 lakh, and at 12.5%, the tax comes out to be 1,16,000. But you can reduce this through tax harvesting. Each year, after completing 1 year of investment, sell your fund to realize gains up to 1.25 lakh tax-free. Then reinvest the entire amount in the same fund. Repeat this annually for 9 years. By the end, you will save significant taxes. Now check the table on your screen for the exact results. After the first year, your gain is 60,000 rupees. When you sell the fund, this 60,000 is booked as a gain since it's below 1.25 lakh. No tax applies. You then reinvest 5.6 lakh into the same fund, setting a new cost price of 5.6 lakh rupees. Now by the second year, assuming a 12% return, 5.6 lakh grows to 6.27 lakh with a gain of 67,000 rupees. You sell again, book 67,000 profit and pay no tax since it is under 1.25 lakh. If you follow this process for 10 years, you can save significantly on taxes. So for 7 years, your tax is zero. From 8th year onward, tax applies, but the total across 8th, 9th and 10th year is just 9,073 rupees. Without tax harvesting, you would pay 1.16 lakh rupees. This strategy called tax harvesting or tax gain harvesting applies only to long-term capital gains. Interestingly, not just in case of profits, but tax harvesting works in case you have made losses on investments as well. So tax gain harvesting works for long-term capital gains, but tax loss harvesting applies to both short-term and long-term losses. Understand it like this. Suppose you invested 1 lakh rupees each in two equity funds, A and B. After 6 months, fund A's value drops to 80,000, while fund B grows to 1.2 lakh rupees. You sell fund B booking a 20,000 gain, which is taxed at 20% since it's within a year. So it results in a tax of 4,000 rupees. Now by selling the loss-making fund A, you book a 20,000 loss. This loss offsets fund B's 20,000 gain and thus bringing your tax to zero. The same applies to long-term capital losses. But in equities, tax applies only on gains exceeding 1.25 lakh rupees. Now, the key point is that long-term losses can offset only long-term gains, but short-term capital losses can offset both short-term and long-term gains. And well, interestingly, tax laws do not differentiate between asset classes. Gains and losses from equity, debt, real estate or commodities can all offset one another. And this brings us to the end of the video. We hope you would have found this interesting. And if you did, don't forget to like, share and comment. We'll be back with another insightful video soon.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.